$3.5 trillion under management, the lowest fees really by far in the category, a completely transparent set of tools and solutions that really teach somebody the principles of how to make money and how to think intelligently about investment. Who else has delivered that to that scale in finance in history?
Well, I mean, I guess I'd say not very many people, but for a very definite reason. And that is most people in this business are trying to make money for themselves rather than for their shareholders. And so they're not focused on giving the shareholder the best break. And if you think about it at all deeply, you realize that the stock market creates nothing. It reflects the returns earned by investors, by Investment America, the corporations of the country, the public corporations. And they have earnings. They pay out dividends. They reinvest the earnings in the business. That's where the value is created. You access that value. You access that value through investing. So then the question is, corporate America has created this kind of value. What comes down to Investment America? And the answer is exactly what they earn, except that it's then the question is, how is it allocated between Wall Street, essentially the financial system, and Main Street, the people who invest? And the allocation to Wall Street is the objective of this business because everybody is in Wall Street. And what we should be doing is working, and what we have been doing here at Vanguard, is putting the investor first and innovating for the investor and not for ourselves, and trying to keep costs as low as we can, which is rock bottom.
I want to go back to something you mentioned a minute or two ago about the importance of fees and really looking at what you're paying for that return that's being created by corporate America or corporations around the world, and then the fee that is the one interruption for you to actually getting that return. Would you suggest then that somebody who's going through and evaluating a mutual fund to purchase, and there are sites and services like Morningstar and others that have all of the ratings and reviews and they tell you about the manager and all the rest, would you say that the best thing that someone could do would be to remove all of those factors and just rank them by fee and buy the ones that have the lowest fee? If you could do that without looking at anything else, obviously you'd end up with a number of Vanguard funds because your fees are average 0.12%. But is that a better methodology than the average person is using to pick a mutual fund?
Well, I'm tempted to say, and will say, ask Morningstar. They say that their sophisticated rating system works almost as well as simply rating the funds by cost.
Wow.
So they have entered the confessional booth. The problem is, in the financial business, value and cost are the reverse sides of the same coin. When you go into Costco or anything else you can think of, there's a value in your mind. You buy a Mercedes-Benz, you got a lot of value out of driving. Now, I don't know why anybody would get any great pleasure out of that, but maybe it's pride. Maybe they think Mercedes-Benz is a new star somewhere in the sky. I don't know. But you can't directly associate the cost with the value. Mm-hmm. But in the mutual fund business, it's how the returns are divided up between the marketplace and the investor. Mm-hmm. So this is a hard business to do it in without giving up your profits. Mm-hmm.
What about risk? How do you assess risk? If we're now saying, oh, put your money in, let it ride, add to it over time, start with $15,000, you find yourself 40 years later, you're going to have $900,000 or something approximating that, depending on how the overall market does in the next 40 years. But what about larger risks? What risk could reasonably threaten that in the next 40 years? Or are you telling your grandchildren in their 20s now, just go with this game plan?
Well, I do for my grandchildren. They can change it when they get there. They don't really know how much money I put away for them over all these years. And I always put it in balanced index fund. Mm-hmm. 60% S&P 500, or total stock market, I should say, and 60% total bond market.
60 and 40. You said last time we talked that anyone watching could put all of their money into that one fund and make it their sole investment throughout life.
Now, it's conservative, and it protects you against your emotions, because when the market goes way down, stock market goes way down, the bond market actually usually goes up a little bit under that circumstance. So investors have behavioral problems, and they panic if their account goes down 50%. An account like this probably goes down 32 or 3%. Okay. So you don't get exposed to the worst of it. Mm-hmm. there's no question that a 100% stock portfolio will do better in the long run. I mean, that's just the numbers. As stocks will return over the long run, not every 25-year period, but probably 3 out of 4, stocks will return more than bonds. They will be the highest returning investment because they have a higher risk. Now, what is risk? Let me tell you what it is not. It is not volatility. We use volatility to measure risk. You know, if the market goes up, let me say, or down 25%, and you own the market, that's what you do. If you want to reduce the volatility in a balanced fund, you know, you maybe go up or down 15%. And if you want to get an extremely aggressive fund, maybe up and down 40%. But it's symmetrical and fairly symmetrical. And so that's a way of measuring, but it's a short-term thing. In the long term, the risk is that you may lose one hell of a lot of money. If you started buying stocks in 1919 or 1920 or 1918, you were doing fine through 1929, and then you lost 90% of your money in an all-stock portfolio.
And it took you another 15 years to get back to even or something.
Yeah, actually a little more than, just about right, 15 years in mid-40s. And so those kind of risks are big risks. And they're risks that we can't measure. There are risks that come from things like, what is the probability that our society will collapse? What is the probability that with all the undercurrents that are going on in American society between the haves and have-nots, and the haves, the superior, larger races and the minorities, those gaps are very wide, and I'm deeply concerned that we may get in some real trouble, and that's why I describe myself as so conservative that I'm liberal. I want to protect our society, and therefore I want to protect those segments of society that haven't been treated fairly to the best of our ability. And then there are the known risks, like nuclear war, worldwide disease, plague kind of thing, religious uprisings, the things that we know about and worry about today. And then, as my fellow Princetonian Secretary of Defense Donald Rumsfeld says, those are the known unknowns. And what about the unknown unknowns? And of course, since they're unknown, we can't comment on that, about that.
But none of those unknown unknowns, or none of those big risks, cause you to change your investment approach, I guess, because the assumption is if the market goes down 90% on the Bogle family portfolios, that there are so many other problems in the world, it's probably not going to be a make or break thing for you that your stock portfolio is down.
Well, no, as a wise man once said, if there's nuclear war, it won't matter a hell of a lot whether you own stocks or bonds. It's gone. Society is gone. It's frightening to think about. And I think that given the enormity of these kind of risks that I've described and the unknown risks that we really don't know, we don't know what they are, which is kind of frightening. But invest you must. As I've said to people, probably on television or interviews kind of thing, the one way to assure that the value of your retirement plan is zero is to not invest a penny, and zero is guaranteed. So you have to put your money to work. In the extreme circumstance, even cash is not going to help you. It's not going to be any good if the nuclear bombs start going off. It's a frightening, fragile world that we live in. So you can sit and worry about it every day, and in certain respects, if you like to worry, it's a good thing to worry about. But you kind of have to get on with your game, prepare for the future, and hope that those extreme risks don't come home to roost.
But what about the concept that if we see a market continue to decline, that people will be disappointed in all index funds because they find that the managers are not allowed to sell to get out of the market?
Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market and 4%, only 4% at the peak. They were bearish when they should have been bullish and bullish when they should have been bearish. So the index at least steers a steady course.
Do you still expect, Mr. Bogle, that if this becomes what people call a stock pickers market, that the index funds will continue to outperform the stock pickers?
I don't think there's such a thing as a stock pickers market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, the other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of one.
Stock market is just a big gambling machine, and it's probably rigged too, so I don't invest.
In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history.
When it comes to investing, I just give my money to my friend Frank over at Name Your Big Wall Street Bank. I don't really know what they're doing, but is such a friendly person. I'm sure that they're taking care of my finances for me. I mean, a huge number of people don't want to deal with this subject. It's like dentistry for them. And if they can outsource dentistry, they're going to be very happy to do so, and they turn to their college friend or friend of a friend who happens to work at a big firm and has been trained to be very friendly with them, and they're just going to hand their money and say, please don't lose it, Frank, and I trust you.
Look at the numbers. How is Frank doing for you? How has he done for his other clients? Why is he trading all the time? Because that's good for him and not good for you. So you should basically, this is not a personal matter about finding a friend. As they say in Washington, you know this, Tom, if you want a friend in Washington, get a dog. And you wouldn't do this with your dog, and I don't think you should do it with your friend either. These are honest people by and large. They don't really realize that the more they trade, more they have you trade, the less well you do. So activity is essentially the curse of Wall Street. If there's no activity in Wall Street, there is no money in Wall Street. Every day, all those $30 trillion of stock that's changes hands, something like that. One person's buying, one person's selling. It creates no value. It shifts value from A to B or from B to A, and the system of Wall Street takes its cut out of the middle. So the gambling, the casino comes up again. You know, the croupiers of Wall Street, like the croupiers of Vegas, as it's called, I believe it's Las Vegas, he said, and all the bettors that bet red and all the bettors that bet black are equal, but they don't divide up the returns because there is the croupier, and he's got this rake, and he pulls his share off the table. So,
Out of your retirement fund.
Love Frank. Buy him a drink every once in a while. Encourage him to tell you the latest jokes, which you would probably do if he was the broker. But think about investing as a long-term thing that doesn't involve any trading whatsoever.